I watched my business partner turn $10,000 into $12 billion over 60 years. I watched him do it without luck, without insider information, without a single brilliant move that you or I couldn't replicate. And in that same 6 decades, I watched thousands of intelligent, hardworking, educated people earn more money than we did in any single year and end up with almost nothing. Doctors making $500,000 annually who retired broke. Lawyers billing $400 an hour who died in debt. Engineers, executives, entrepreneurs, people far smarter than me in their specific domains who accumulated nothing despite decades of high income. The difference wasn't intelligence. It wasn't work ethic. It was a handful of decisions they made about where to put their money. More specifically, it was 7 categories of investments they poured wealth into that I avoided completely. Not because I was brilliant, because I'd seen the mathematics, studied the history, and watched enough people lose enough money to recognize a pattern. What I'm about to tell you isn't theory. It's not prediction. It's observation from 7 decades of watching capital flow from one pocket to another and noticing which pockets always seemed to empty while others compounded relentlessly. These 7 investments destroyed more wealth among people I knew personally than market crashes, bad luck, and poor timing combined. And the tragedy is that most of them were following conventional wisdom, doing exactly what financial advisors, parents, and society told them was the smart, safe, responsible choice. The first wealth destroyer I avoided my entire life was something 90% of Americans bought enthusiastically, something financial advisors built entire careers selling, something that carried the word investment right in its name, despite being one of the worst investments ever created. Whole life insurance, universal life, variable life, every variation of permanent life insurance that promised to combine insurance protection with investment growth. The pitch was seductive. You need life insurance anyway, they'd say. So why not buy a policy that builds cash value you can borrow against or withdraw in retirement? You're not just buying protection, you're building an asset, tax-free growth, guaranteed returns, the safety of insurance combined with the growth of investments. It sounded perfect. It was mathematical poison. Here's what they never explained clearly. When you buy whole life insurance, roughly 50 to 100% of your first year's premiums go directly to the agent as commission, not into your cash value, into their pocket. You pay $5,000, they get $5,000. You get insurance coverage and essentially nothing in your cash value account. Over the next decade, the insurance company slowly, grudgingly begins allocating some of your premiums to this supposed investment account after deducting insurance costs, administrative fees, mortality charges, and profit margins. By year 15 or 20, if you're lucky and haven't surrendered the policy out of frustration, you might have cash value equal to what you paid in. Might. The returns they advertised, 4%, 5%, sometimes higher, weren't returns on your total premiums paid. They were returns on cash value after all those costs were deducted. I watched a friend pay $5,000 annually into a whole life policy from age 30 to age 60. 30 years, $150,000 in premiums. His cash value at 60 was $168,000. $18,000 of growth over 30 years. That's a 0.4% annual return. If he'd bought $20 per month term insurance for the same death benefit and invested the difference, $4,760 annually, into the stock market, averaging 10%, he would have had $870,000. The difference between $168,000 and $870,000 is $702,000. That's what whole life insurance cost him. Not in fees, in opportunity cost, in wealth he could have built but didn't, because someone convinced him insurance and investment belonged in the same product. They don't. Insurance is for transferring risk. Investment is for building wealth. Combining them is like buying a car that's also a boat. It does both poorly, costs more than buying each separately, and the salesman makes a fortune selling it to you. I never bought permanent life insurance. I bought cheap term insurance when my children were young and I had obligations. When I had enough wealth that my death wouldn't financially devastate my family, I let it lapse. The money I didn't waste on whole life insurance compounded in businesses and stocks for 50 years. That decision alone probably added 8 figures to my net worth. Not because I was smart, because I understood that when someone's compensation depends on you buying something, their advice about whether you should buy it is worthless. The whole life insurance industry is built on a beautiful scam. Take people's legitimate need for protection, add complexity and jargon they don't understand, pay salespeople massive commissions to push products people don't need, and wrap it all in the language of financial responsibility. Providing for your family, building your future, being a responsible adult. It's genius, really. They took the worst investment vehicle ever created and convinced an entire generation it was prudent. I watched this same friend, the one who accumulated $168,000 in cash value over 30 years, defend his whole life policy, even after I showed him the mathematics. He'd been paying premiums for 25 years when we had this conversation. I asked him a simple question. If you could go back to age 30, knowing what you know now, would you buy this policy again? He thought for a long moment. No, he admitted, absolutely not. So why, I ask, are you continuing to pay premiums now? Because I've already invested so much, he said. I can't just walk away from 25 years of payments. That's when I knew the insurance company had won. They'd convinced him that continuing a bad investment was somehow better than admitting he'd made a mistake and redirecting his capital to something that actually built wealth. It's the sunk cost fallacy in its purest form, and it keeps people trapped in wealth-destroying products for decades. The insurance salesman who sold him that policy made $50,000 in commissions over the life of the policy. My friend made $18,000 in growth. The insurance company made hundreds of thousands in profit. Everyone made money except the person who actually needed to build wealth. That's not an investment. That's a transfer of wealth from the financially unsophisticated to the financially predatory. The second investment I avoided was something people built their retirement dreams around, something society treated as the foundation of financial security, something that combines massive leverage with illiquid assets and transaction costs that would make a loan shark blush. Real estate. Not your primary residence, I'll address that separately. I mean investment real estate, rental properties, vacation homes you tell yourself are investments, commercial buildings, real estate investment trusts, the entire religion of property ownership as wealth building. The pitch was even more seductive than life insurance because it came wrapped in the American dream. Buy property, watch it appreciate, collect rent, build equity, leverage other people's money through mortgages, retire rich. I heard it 10,000 times. I watched hundreds of people follow that path. And with very few exceptions, people who bought large quantities of property in high growth areas and held through multiple market cycles. It destroyed wealth compared to simply owning businesses through stocks. Here's the mathematics nobody mentions when they're selling you real estate. First, transaction costs. When you buy property, you pay closing costs averaging 3 to 5%. When you sell, you pay realtor commissions averaging 6%. Buy a $500,000 property. Immediately you're down $15,000 to $30,000 just in transaction costs before you've collected a single dollar of rent or appreciation. Compare that to buying stock. 0 transaction costs with modern brokerages. Second, carrying costs. Property taxes in most states run 1 to 2% of property value annually. Homeowners insurance another 1%. Maintenance averages 1 to 2% annually, and that's if nothing major breaks. You're paying 3 to 5% of property value every year just to own it. A $500,000 property costs you $15,000 to $25,000 annually in taxes, insurance, and maintenance. That's before mortgage interest if you're leveraged. Third, illiquidity. When I want to sell a stock position, I click a button and have cash in my account in 2 days. When you want to sell property, you list it, wait for a buyer, negotiate, go through escrow. And if you're lucky, you have cash in 90 days. If you're unlucky, wrong market timing, economic downturn, you wait years or sell at a loss. Fourth, depreciation and obsolescence. Property ages, roofs need replacing, HVAC systems die, neighborhoods change. Businesses I own through stocks don't have roofs that leak or tenants who stop paying rent or foundations that crack. They have earnings that compound. Fifth, leverage works both ways. People love talking about using mortgage leverage to control a $1 million property with $200,000 down. What they don't mention is that if the property drops 20% in value, you didn't lose 20%, you lost 100%. Your $200,000 equity became 0. I watched this happen to brilliant people in 2008. Doctors, lawyers, engineers, who'd accumulated millions in home equity and rental properties, all leveraged, all certain real estate only goes up. They lost everything, not because they were stupid, because they didn't understand that leverage magnifies losses as aggressively as it magnifies gains. I ran the numbers in 1965 and the numbers were clear. Over long time periods, stocks outperformed real estate by roughly 2 to 3 percentage points annually. That doesn't sound like much. Over 40 years, it's the difference between a dollar becoming $15 or $45. The difference between comfortable retirement and generational wealth. But everyone wanted real estate because they could see it, touch it, drive past it. They couldn't see ownership in a business. So they bought property and spent their weekends fixing toilets and dealing with tenants, while I bought stocks and spent my weekends reading. 40 years later, I had more wealth and more time. They had property that appreciated roughly with inflation and decades of memories dealing with problem renters. Now let me be clear about what I'm not saying. I'm not saying home ownership is bad. I'm not saying property has no place in a portfolio. I'm saying that for most people, investment real estate is a trap disguised as an opportunity. It appeals to our desire for tangible assets, our belief that we can see and control our investments, our cultural mythology about property ownership. But the mathematics are brutal. A friend of mine bought 3 rental properties in the 1990s, paid about $200,000 each, $600,000 total, spent 20 years managing them, dealing with repairs, evictions, property taxes, insurance claims, sold them in 2015 for about $350,000 each, roughly $1 million total. Sounds like a win, right? He more than doubled his money. Except when you factor in all the carrying costs, property taxes, insurance, maintenance, vacancy periods, property management if he hired help. His actual return was about 4% annually. And that doesn't count the hundreds of hours he spent dealing with tenant issues, repair emergencies, and administrative headaches. If he'd taken that same $600,000 and bought an S&P 500 index fund, he would have had approximately $2.4 million by 2015, with zero time investment and zero tenant phone calls at 3 a.m. about broken water heaters. The difference between $1 million and $2.4 million is $1.4 million, plus 20 years of his life he spent being a landlord instead of doing literally anything else. That's the opportunity cost nobody calculates when they're buying rental property. The third investment I avoided was something even more culturally sacred than real estate, something people literally went to war over for thousands of years, something that's supposed to be the ultimate store of value and hedge against catastrophe: gold, silver, precious metals, commodities that produce nothing, generate no cash flow, create no value, and sit in a vault somewhere while you hope someone else will pay you more for them tomorrow than you paid today. This might be the most irrational investment humans ever created, and I spent 7 decades watching intelligent people pour wealth into it for reasons that collapse under the slightest logical scrutiny. Here's the argument for gold. It's been valuable for 5,000 years. It's a hedge against inflation. It's a crisis hedge when paper money becomes worthless. It's tangible and finite. Governments can't print more of it. All of that is technically true. It's also completely irrelevant to building wealth. Let me walk you through the actual mathematics of gold ownership. From 1975 to 2023, 48 years, gold appreciated from about $165 per ounce to about $2,000 per ounce. That's roughly 12 times your money, which sounds impressive until you compare it to literally any productive asset. The stock market over that same period went up roughly 90 times. $1 invested in stocks in 1975 became $90. $1 invested in gold became $12. But it's actually worse than that, because gold has carrying costs. If you buy physical gold, you need to store it somewhere secure. If you store it at home, you risk theft. If you store it in a safe deposit box or vault service, you pay annual fees. If you buy gold through an exchange-traded fund, you pay management fees. So that 12 times return gets reduced to maybe 10 times after carrying costs. Meanwhile, stocks paid dividends that compounded over those 48 years, turning that 90 times return into something closer to 150 times if dividends were reinvested. The gap between gold and stocks isn't just large, it's generational wealth versus modest gains. But people don't buy gold for returns. They buy it for safety, for crisis insurance, for the belief that when everything collapses, gold will still have value. Let me tell you what actually happens in a crisis. I lived through stagflation in the 1970s, Black Monday in 1987, the dot-com crash, the 2008 financial crisis, the pandemic. You know what had value in every single one of those crises? Ownership and productive businesses. Companies that made products people needed, provided services people wanted, generated cash flow regardless of what currency was doing. Gold spiked temporarily during some of those crises, then fell back. Businesses kept producing earnings. Here's the fundamental problem with gold that nobody wants to acknowledge. It's not an investment. It's speculation. Investment means putting capital into something that produces a return, a business that generates profit, a bond that pays interest, real estate that generates rent. Gold just sits there. You buy it, store it, Hope someone pays you more for it later. That's not investing. That's the greater fool theory. You're betting that a greater fool will pay more than you did for something that produces nothing. I never bought gold, not an ounce, not as a hedge, not as insurance, not as a speculation. Every dollar I could have put into gold went into businesses instead. Over 7 decades, that decision compounded into a wealth difference so vast that I can't even calculate it precisely. If I'd put 10% of my net worth into gold in 1965, which many financial advisors recommended, I'd have millions less today, millions. And I'd have spent 7 decades worrying about whether civilization was going to collapse, instead of reading annual reports and learning how businesses work. The psychological cost of gold ownership is something nobody discusses. Gold bugs are the most paranoid, pessimistic, perpetually disappointed investors I've ever met. They're always waiting for the collapse, the hyperinflation, the currency crisis that will finally prove them right. Meanwhile, the world keeps functioning, businesses keep producing, and the stock market keeps compounding. I asked a gold investor once what would have to happen for him to admit gold was a bad investment. He couldn't answer, because for true gold believers, there's no falsifiable hypothesis. If gold goes up, they were right. If gold goes down, it's temporary manipulation and they should buy more. If gold goes sideways for decades, it's preserving value while everything else is in a bubble. It's the perfect unfalsifiable investment thesis, which means it's not an investment thesis at all. It's a religion. And like most religions, it makes people feel secure without actually improving their material circumstances. The fourth investment I avoided was something that combined the worst features of whole life insurance and real estate: high fees, illiquidity, poor returns, and complexity that disguised how bad the deal actually was. Actively managed mutual funds, hedge funds, private equity funds, any investment vehicle where you pay someone else, usually 1% to 2% annually, plus performance fees to invest your money for you. This might be the most lucrative scam in financial history. And it worked for decades because it appealed to a fundamental human weakness: the belief that experts can do what we can't, and that superior returns are worth paying for. Let me destroy that belief with mathematics. The average actively managed mutual fund charges about 1.3% in annual fees. That doesn't sound like much. It's barely noticeable on your quarterly statement. But over 30 years, that 1.3% fee costs you approximately 35% of your total returns. Not 35% of your fees, 35% of your wealth. If the market returns 10% annually and you're paying 1.3% in fees, you're not getting 8.7%. Because of compounding, you're getting about 6.5%. And that's assuming your fund manager matches the market return before fees, which 95% of them don't over long time periods. The actual data is devastating for the active management industry. Over 15-year periods, approximately 92% of active fund managers underperform their benchmark index after fees. Over 20-year periods, it's 95%. Over 30 years, it approaches 98%, which means if you pick an actively managed fund, you have a 2% chance of beating a simple index fund that charges 0.03% in fees and requires zero expertise to buy. Those aren't odds. That's a certainty of underperformance. But the mutual fund industry is a $3 trillion business, so they're very good at explaining why you should ignore the data. They show you the funds that did beat the market, ignoring survivorship bias. The hundreds of funds that closed because they performed so poorly. They show you past performance, ignoring that past performance doesn't predict future results. They sell you on the expertise of their managers, ignoring that genius doesn't overcome 1.3% annual drag plus underperformance. I watched colleagues invest in hedge funds in the 1980s and 90s, when hedge funds were the hot new thing. 2% annual management fee, plus 20% of profits above a certain threshold. The pitch was that these managers were so skilled, so connected, so intelligent, that they could generate returns that would dwarf the market even after those massive fees. Some did for a while. Most didn't, ever. And even the ones that generated great returns had a funny thing happen. As they grew larger and attracted more capital, their returns regressed toward the mean. The edge disappeared. But the fees didn't. I met a hedge fund manager in 2003 who generated 30% annual returns for 5 years. Brilliant guy, Wharton MBA, worked at Goldman Sachs, had a proprietary trading system he'd developed. He was managing about $50 million. I asked him what he thought would happen to his returns if he had $5 billion to manage instead of $50 million. He got very quiet. Then he admitted that his strategy wouldn't scale. His edge existed in small, inefficient pockets of the market that couldn't absorb large capital flows. If he had $5 billion, he'd have to invest differently, and his returns would probably drop to 15%, maybe less. But he'd still charge 2 and 20 on that $5 billion, which meant he'd personally make over $100 million per year, even if his investors only got 12 or 13% after fees. That's when I understood the hedge fund business wasn't about making investors rich. It was about making hedge fund managers rich. The incentive structure was perfect for them and terrible for investors. They got paid based on assets under management and performance in up years, but didn't give money back in down years. Heads they win, tails you lose. I never invested $1 in a hedge fund. I never bought an actively managed mutual fund once index funds became available. Every dollar I could have given to an expert manager went into low-cost index funds or individual stocks I researched myself. Over 40 years, the difference was probably $50 million or more in my personal net worth. Not because I was smarter than hedge fund managers, because I wasn't paying them 1 to 2% annually to underperform what I could get for 0.03%. The mathematics of fees is the most important concept in investing that nobody teaches. If you have $1 million invested and pay 1.3% in fees annually, after 30 years at 10% market returns, you'll have about $13 million. If you invest that same million in an index fund charging 0.03%, you'll have about $20 million. $7 million difference from 1.3%. That's not a rounding error. That's generational wealth transferred from you to the financial services industry. And people pay it happily because they don't understand compounding works both ways. It compounds your returns and it compounds your fees. The industry knows this. That's why they focus your attention on performance and obscure the fee structure. That's why they report returns before fees in their marketing materials. That's why they make fee schedules complex and hard to compare. They're not trying to make you rich. They're trying to extract maximum fees while providing minimum value. And they've been doing it successfully for 70 years. The fifth investment I avoided was something that didn't exist for most of my career, but exploded in the 2000s and became the defining speculative mania of the 21st century. Cryptocurrencies, Bitcoin, Ethereum. Whatever new coin was being shilled this week as the future of money. I watched this unfold with a mixture of fascination and horror, because it combined every element of financial delusion I'd seen in 7 decades. The tulip mania, the South Sea bubble, the dot-com crash, the belief that this time is different, that the rules of economics don't apply, that you can get rich without producing anything of value. Let me be very clear about my view on cryptocurrency. It's not currency because nobody uses it to buy things. It's not a store of value because it fluctuates wildly. It's not a productive asset because it generates no cash flow. It's not a commodity because it has no industrial use. It's a digital token whose only value is what someone else will pay for it, making it the purest form of greater fool speculation ever created. The arguments for cryptocurrency fall apart under minimal scrutiny. First, the scarcity argument. Bitcoin is limited to 21 million coins, they say, which makes it inherently valuable. Scarcity doesn't create value. Usefulness creates value. I can create a limited digital asset right now. There will only ever be 21 million Munger coins in existence. Does that make them valuable? Of course not. Scarcity combined with demand creates value. And the only demand for cryptocurrency is speculative demand. People buy it hoping someone will pay more tomorrow. That's not value, that's musical chairs. Second, the decentralization argument. Cryptocurrency is free from government control, they say, which makes it superior to fiat currency. Setting aside the fact that most cryptocurrency transactions happen through centralized exchanges that governments can and do regulate, let me ask a simple question. Why is freedom from government control valuable? The answer crypto enthusiasts give is that governments debase currency through inflation, which is true. But the alternative they're proposing, a deflationary currency that increases in value over time, creates its own massive problems. If your currency becomes more valuable by holding it, nobody spends it. Economic activity grinds to a halt. We know this from history. The gold standard created deflationary spirals that led to depressions. That's why every developed economy moved to fiat currency. Not because governments wanted control, because deflationary currencies don't work as mediums of exchange. Third, the blockchain technology argument. Even if cryptocurrency fails, they say, blockchain technology will revolutionize everything. Maybe. But you don't need to own Bitcoin to benefit from blockchain technology, any more than you needed to own pets.com to benefit from the internet. Most transformative technologies don't make their early investors rich. They make their users' lives better and create value in unexpected places. The internet didn't make most internet investors rich. It made Amazon and Google and Facebook rich. And most of those companies didn't exist when the internet boom was happening. I watched Bitcoin go from $1,000 to $20,000 to $3,000 to $60,000 to $20,000 again. Every boom attracted new investors, convinced they'd found the secret to easy wealth. Every bust wiped out those investors and set up the next boom. It's a perfect cycle of greed and fear, and the only consistent winners are the early adopters who got in at pennies and the exchanges who collect fees on every transaction. I never bought cryptocurrency, not a dollar. Not as a speculation, not as a hedge against government currency, not because I thought I understood the technology. Every argument I heard for why I should buy it sounded exactly like arguments I'd heard in 1999 for why I should buy pets.com and Webvan and eToys. Revolutionary technology, first mover advantage, network effects. The old economy doesn't understand the new rules. All of it was true about the technology, and all of it was irrelevant to the investment returns. The companies went bankrupt, the technology thrived. The same thing will happen with cryptocurrency. Some version of blockchain technology will probably become infrastructure we all use without thinking about it, like TCP/IP protocols. And the people who bought Bitcoin at $50,000 will have lost most of their money. because technology revolutions and investment returns are different things. Great technology often makes terrible investments. The best time to invest in a technology is not when it's revolutionary and exciting and everyone's talking about it. It's when it's boring and profitable and producing cash flow. Amazon wasn't a good investment in 1999 when everyone was talking about it. It was a good investment in 2003 after it had crashed, figured out its business model, and started generating consistent profits. Cryptocurrency has no path to profitability because it's not a business. It's a speculative token, and speculative tokens eventually return to their intrinsic value, which in the case of something that produces nothing and does nothing useful is approximately zero. People get angry when I say this. They tell me I don't understand the technology, that I'm old and scared of innovation, that I missed the opportunity of a lifetime. Maybe, but I've been hearing that I don't understand the next big thing for 70 years. And I've watched the people who claim to understand it lose fortunes. Well, I compounded wealth in boring businesses that made products and generated profits. I'll take that trade every time. The sixth investment I avoided was something paradoxically popular among people who considered themselves sophisticated investors. People who'd read the right books and understood the theory and wanted to optimize their returns with scientific precision. Individual bonds, corporate bonds, municipal bonds, treasury bonds, any fixed income security where you loan money to an entity in exchange for a promised interest rate. On the surface, bonds seem like the safest, most rational investment possible. You know exactly what you'll get paid and exactly when. No volatility, no uncertainty, just steady, predictable returns. The problem is that steady, predictable returns are steady, predictable wealth destruction once you factor in inflation and taxes. Let me show you the mathematics. A 10-year Treasury bond today yields approximately 4%. Seems reasonable. But inflation is running about 3% annually. So your real return after inflation is 1%. Then taxes. If you're in the 37% tax bracket, which most high earners are, you pay 1.48% of that 4% to the government, leaving you with 2.52%. Subtract 3% inflation from 2.52% nominal return, and your real after-tax return is negative 0.48%. You're losing purchasing power. You're getting poorer, slowly and predictably. But bonds are safe, people say. You get your principal back. That's true in nominal terms and completely false in real terms. If you invest $100,000 in bonds, yielding 4% for 30 years, you'll have your $100,000 back plus your interest payments. But that $100,000 will buy what about $41,000 buys today after 3% annual inflation. You preserved your nominal capital and lost 59% of your purchasing power. That's not safety, that's guaranteed impoverishment. The only time bonds made sense as an investment was when interest rates were higher than inflation plus taxes. That happened in the early 1980s when Paul Volcker raised rates to combat inflation. And you could buy treasury bonds yielding 15% when inflation was 10%. A 5% real return was worth considering. But those conditions existed for maybe 5 years out of the last 50. The rest of the time, bonds were wealth destruction devices marketed as safe investments. I watched friends in the 1990s and 2000s build bond portfolios because their financial advisors told them that at their age, they needed safety and predictability. Those friends retired with portfolios that generated $50,000 or $60,000 in annual income from bonds. Sounds comfortable until you realize that $50,000 buys what $25,000 bought when they retired. Their income stayed flat while their cost of living doubled. Meanwhile, I kept 100% of my investable assets in stocks. Productive businesses that raised prices with inflation, grew earnings, increased dividends. My income in retirement grew at 8 to 10% annually. Not because I was taking more risk, because I understood that the safest long-term investment is ownership in productive assets, not loans to borrowers at fixed rates. The bond industry, like the insurance industry and the mutual fund industry, exists primarily to transfer wealth from unsophisticated investors to financial intermediaries. When you buy a bond through a broker, you pay a spread, the difference between what the broker paid for the bond and what they sell it to you for. That spread is often 1 to 3% of the bond's value, which on a bond yielding 4% means you just gave away the first year's interest to your broker. Then you pay taxes on the interest every year. Then inflation erodes the purchasing power of your principal. After all those costs, you're lucky to break even in real terms. But bonds feel safe because they don't fluctuate in value the way stocks do. This is the greatest psychological trick in finance, convincing people that nominal stability is the same thing as real safety. A stock portfolio might drop 30% in a bad year, but over 30 years it will compound at 8 to 10%. A bond portfolio might never drop in nominal value, but over 30 years it will lose 2 to 3% annually to inflation and taxes. Which one is actually safe? The one that made you richer, or the one that felt stable while making you poorer? I never allocated more than a tiny fraction of my wealth to bonds, and that was only for liquidity, having cash available for opportunities without having to sell stocks at bad times. Every dollar I didn't put into bonds went into stocks instead. Over 50 years, the difference was probably $30 to $40 million in my net worth. Not because stocks are magical, because bonds are mathematically guaranteed to underperform inflation-adjusted stock returns over long periods. And I understood that feeling safe is different from being safe. The only financial safety comes from owning productive assets that grow in value faster than inflation. Bonds don't do that. Bonds are a bet that the future will be worse than the past, that economic growth will slow, that businesses will stop innovating. It's a profoundly pessimistic investment thesis, and pessimism is expensive. Optimism, the belief that human ingenuity will continue creating value, has been the only rational investment thesis for all of human history. I chose optimism. I chose businesses. I chose stocks. And I ended up far wealthier than the people who chose safety and predictability and bonds. The seventh and final investment I avoided was perhaps the most emotionally difficult to resist, because it wasn't marketed as an investment at all. It was marketed as a lifestyle choice, a symbol of success, a reward you deserved after years of hard work. New cars, luxury automobiles, vehicles that depreciate the moment you drive them off the lot. This might seem like a strange thing to include in a list of investments, but that's exactly the point. People treat cars like investments. They finance them, trade them in, upgrade them, when they're actually one of the worst financial decisions you can make. Let me show you the real cost of a new car. The average new car in America costs about $48,000. Most people finance it over 5 or 6 years at 5 to 7% interest. By the time you've paid off the loan, you've paid $54,000 to $57,000 when you factor in interest. But that's not the real cost. The real cost is opportunity cost, what that money would have become if you'd invested it instead of spending it on a depreciating asset. $48,000 invested at 10% annual returns becomes $124,000 in 10 years, $314,000 in 20 years, $815,000 in 30 years. That's not a rounding error. That's retirement security. That's your children's education. That's financial independence. And you spend it on a car that's worth maybe $15,000 after 10 years. But people don't think about it this way because cars aren't optional. And new cars feel like the responsible choice. You need reliable transportation. New cars don't break down. You get a warranty. Old cars cost more in maintenance. Every one of those statements is a rationalization that ignores the mathematics. If I were starting over today with nothing, here's what I'd do. I'd buy term life insurance if I had dependents, and zero permanent insurance ever. I'd rent a modest home or buy a small home I could pay off quickly, and invest every dollar I didn't spend on real estate in index funds. I'd buy zero gold, zero cryptocurrency, zero individual bonds. I'd invest in the lowest cost index funds available, probably a total market index fund, and never sell. I'd buy a reliable used car and drive it until it died, then buy another reliable used car. I'd avoid every financial advisor who charges a percentage of assets under management. I'd read annual reports and learn how businesses work instead of watching financial news. I'd spend money only on things that produced value: education, health, relationships, tools that improve my earning power. I'd save at least 50% of my after-tax income. And I'd do this for 30 years without deviation. The result would be financial independence by my 50s and wealth by my 60s, regardless of starting income, regardless of luck, regardless of market timing. Because the mathematics of compound interest are undefeated. 8% annual returns double your money every 9 years. In 30 years, that's 3 doublings. $1 becomes $8. 100,000 becomes 800,000. 500,000 becomes 4 million. The only question is whether you can avoid the 7 wealth destroyers long enough to let compounding work. Most people can't. They get sold whole life insurance in their 30s. They buy investment real estate in their 40s. They panic into gold during a crisis. They pay mutual fund fees for decades. They speculate on cryptocurrency. They hide in bonds for safety. They buy new cars every 5 years. And they retire at 65 with less than they would have had if they'd simply bought an index fund at 25 and never touched it. That's the tragedy. The solution is simple, free, available to everyone, and requires no special knowledge or expertise. But it requires the one thing most people can't sustain: the willingness to ignore conventional wisdom, resist social pressure, delay gratification, think in decades, and be boringly consistent. I spent 70 years being boringly consistent. I avoided the 7 wealth destroyers. I bought productive assets and held them forever.